Welcome to Success Beyond Borders from Ungulum.
Great to be here.
Here on Success Beyond Borders, we take a close look at the ideas and trends really shaping the media and tech worlds.
Absolutely.
And today we're diving deep into a concept called quality of revenue, QOR for short.
QRR.
It's something, well, really vital for anyone in leadership, investment, strategic roles, especially in fast-moving industries like ours.
Definitely. Media tech SaaS. It's crucial.
So our exploration today is inspired by Ungulum's insightful article, The Invisible Engine.
A really good piece.
Yeah, you can find it on their website, ungulum.com. And honestly, there's a ton of stuff there. Go-to-market strategy, sales as a service, fractional sales leadership.
They covered a lot of ground. Client work in media and entertainment, high-tech, PE and TMT, telecom.
Right, plus their insights cases, all the usual site info too. But our goal today, our mission, let's say, is to really get why QOR is so critical for predicting future success in media and tech, and how it fits with traditional financial analysis to give you a clearer picture.
Precisely. We see it all the time, don't we?
Yeah.
Companies look solid based on past financials, but then they just struggle.
Yeah.
Struggle to keep that growth going.
Exactly.
So this deep dive into quality of revenue, it's about understanding why that happens, and maybe more importantly, what you can actually do about it. Identify it, address it.
Okay, let's set the scene then. There's this scenario in The Invisible Engine, and I think a lot of our listeners might find it familiar. Imagine a private equity investor. They've done their homework, really thorough due diligence on a promising tech, media, or maybe a SaaS company.
Standard practice.
Yeah.
Quality of earnings review included, of course.
Of course. Everything looks good. Historicals are strong. So they go ahead, make the acquisition. They're anticipating, significant, sustainable growth.
That's the plan.
But it doesn't happen. The growth just doesn't materialize. Revenue flattens out, maybe even drops. And suddenly, the focus shifts, right? It's all about cost cutting, maybe some strategic pivots. But that value uplift they expected, nowhere in sight.
Yeah, tough spot.
So the big question is, how does this happen? How can smart, experienced investors looking at all this data miss something so fundamental about the company's ability to actually generate revenue consistently?
It's a really, really relevant question.
Yeah.
And like the article points out, it highlights this key paradox.
Which is?
Well, pretty much everyone agrees, right? Organic revenue growth is the fundamental driver of enterprise value.
Absolutely. Fuels cash flow, impacts those exit multiples.
Exactly. Those exit multiples, basically how the company gets valued when it's sold.
Yeah.
Strong growth bumps that number up significantly. And especially now with things like rising interest rates, competition, a company's ability to just consistently win new business and bring in revenue.
Yeah.
That's its most valuable asset, no question.
Totally agree. And yet, accurately forecasting and then actually achieving that organic growth, it's still a massive challenge.
It really is.
Even with, tons of real-time data, fancy financial models, investors, company leaders, they often struggle to nail it. So the article asks why. Why do organizations, even drowning in data, still misjudge their future revenue engine? Why is this core capability, generating revenue consistently, still a blind spot even during intense due diligence?
Well, a big part of the answer, as the Invisible Engine lays out, is the limitations of traditional due diligence.
Okay.
Take quality of earnings, QOE. It's critical, yes, verifies the historical financials.
Yeah.
But the key word is historical.
Right, backward looking.
Exactly. It's fundamentally backward looking.
Yeah.
So it can easily mask underlying problems in how the company actually does business, its commercial execution, how it wins and keeps customers. It might not show weaknesses in sales processes or vulnerabilities just bubbling under the surface of those nice-looking past earnings. So the insight here is you can look healthy historically, but be fundamentally weak going forward. Your ability to generate future revenue might be compromised.
That's a really crucial distinction. Good past earnings don't guarantee future ones. If the engine's sputtering, QOE alone won't necessarily catch that.
Precisely.
And the article also mentions market diligence. Now that does look forward, doesn't it?
It does, yeah.
But the focus there is often external, right? Market size, competition, sector growth. What's missing when you only look at that?
What's often missed is the company's internal capability. Can they actually capture that market opportunity? Just because the market's huge doesn't mean this specific company has the machinery, the aligned teams, the effective processes to grab a piece of it.
Okay.
It's like, having a fast car but a poorly maintained engine. Great racetrack, maybe the market's big, but you're not going to compete effectively.
Got it. Okay, so this brings us right to the heart of it. Quality of revenue. QR,
Mm-hmm.
the invisible engine, introduces QR as this forward-looking analysis. So instead of just looking back, QR tries to assess a company's future potential for generating revenue and, crucially, its ability to sustain it.
Yeah, sustainability is key.
It's not just about market size or past wins. It's about really understanding the underlying operational, functional drivers that make consistent revenue happen.
Think of it like looking inside the engine room of growth.
The engine room. I like that.
Yeah. QRR checks the fundamental parts and how well they actually work together to produce revenue. And the article breaks down several key areas a good QRR analysis digs into.
Okay, what?
First off, the alignment of commercial teams, systems, and processes. So are sales, marketing, operations all pulling in the same direction?
Yeah.
Towards shared revenue goals?
Right.
Are their tech systems talking to each other?
Right.
Are the processes smooth, efficient? Think of like a relay race. If that handoff between marketing and sales is messy...
You lose momentum, lose revenue.
Exactly. You lose momentum, you lose deals, you lose revenue.
That makes total sense. If sales and marketing aren't aligned, or ops can't handle the deals sales brings in, yeah, friction, inefficiencies, lost revenue. What else does QR look at?
Another big one is the robustness of key functional capabilities. The article specifically calls out product management and revenue cycle management.
Okay, why those?
Well, good product management means you're actually building things customers want and will pay for.
Right.
Essential. And revenue cycle management, how efficiently you turn sales into actual cash.
Getting paid.
Getting paid.
Yeah.
It's vital for sustained growth. These functions, they directly feed pipeline traction, as the article puts it. Imagine a company with great products, but they're slow at invoicing or collecting cash.
Even with high demand, their actual cash flow suffers.
Absolutely. Realized revenue takes a hit.
Right. A great product nobody knows about, or sales that don't turn into cash. Both kill growth, no matter how big the market is.
What's next on the QR checklist?
Then you've got the strength of growth leadership, strategic planning, and the kind of overall culture around revenue.
The softer stuff. Sort of, but crucial. Does the company have leaders genuinely focused on growth? Is there a clear, well-executed strategy? Is the whole organization actually aligned and motivated to generate revenue?
Yeah.
This looks beyond just the tangible assets.
That really speaks to those intangible but totally vital elements, doesn't it? Leadership mindset, strategic direction. Easy to miss in a standard financial review, but fundamental for long-term success, long-term revenue growth.
Totally.
And the final key area QRR digs into, according to the article.
The final piece highlighted is the maturity of core operational levers.
Levers like?
Things like pricing strategy. Are they pricing effectively for revenue and profit? Analytics. Are they actually using data to understand customers' performance, make decisions? Key performance metrics. Are they even tracking the right things? And customer experience, is it good enough to keep customers loyal, get repeat business, maybe even referrals?
Wow, okay.
These levers, they directly impact how consistently you generate and grow revenue.
So QOR is really comprehensive. It's looking at everything from team alignment, functional strength, leadership, down to the nuts and bolts of pricing and customer experience that drive revenue day to day.
That's the idea, a holistic, forward-looking view.
And the article then points out some common real-world weaknesses in tech, media, SaaS companies that QOR often finds. What are some typical red flags?
Yeah, you often see things like lagging new revenue growth that can point to issues with customer acquisition or maybe market fit, subpar sales productivity. The sales team just isn't bringing in enough revenue for the investment. Poor pipeline management. You know, a leaky or unpredictable pipeline makes forecasting a nightmare.
Right.
Lackluster digital marketing can really hold back lead generation. And missed retention or upsell opportunities, leaving money on the table with existing customers. These things might not jump out from historical financials, but they absolutely hamper future growth.
These all sound like pretty fundamental problems that could definitely derail growth, even if the past numbers looked okay. And the invisible engine also mentions that specific sectors, like media, have their own unique complexities that QRR is good at uncovering. What kind of nuances are we talking about in media?
Well, in media, you often have these really unique, sometimes very complex payer contracts that can really affect how revenue is recognized, how predictable the cash flow is. Then there's the issue of unpredictable gross-to-net ratios. That difference between what's billed and what's actually received after discounts, allowances, often bigger in media.
Right. Rebates, agency fees.
Exactly. And then protracted DSO days sales. Outstanding.
Right.
How long it takes to get paid. Media can have longer payment cycles, complex billing. So a high DSO really impacts the quality and predictability of revenue. QoE might miss the full impact, but QRR digs into it.
So QRR really gets into the weeds of how revenue actually works in different industries, considering those specific challenges.
He has to.
And this leads to what the article calls a counterintuitive truth. What's this surprising insight?
The counterintuitive bit is this. A company's operational effectiveness, its QRR, is actually a better predictor of future revenue than just its historical financial accuracy, the QoE, or even how attractive the market seems.
Better than past performance and market potential.
Yeah, because past performance is past. Market potential is just potential. Neither guarantees future success. QRR assesses the company's readiness, its actual ability to capitalize on opportunities and turn them into sustained growth. Do they have the engine for it?
It's about having the right internal engine, the processes, to actually convert potential into real sustainable revenue.
Precisely.
And the invisible engine brings up this concept of intangible commercial assets that drive this. What are those?
These are the things you don't see on a balance sheet, but they're critical. Strong team alignment, sales, marketing, customer success working together, using data analytics effectively for decisions. Well-defined, efficient, cross-functional processes that support the customer journey. And, importantly, that growth-oriented leadership mindset filtering through the whole company, fostering a culture that really values revenue generation.
Not on the balance sheet, but vital assets for growth. Okay, so let's talk practical benefits. The article highlights advantages for two groups: PE partners and C-suite execs in tech, media, SaaS. Let's start with private equity. Why is QR increasingly important for them?
For PE firms, yeah, it's becoming more and more critical, especially as traditional due diligence gets, more commoditized. Everyone does QoE.
Right.
QRR offers a competitive edge in deals. It's a vital complement to QoE and market analysis. It lets investors find those hidden growth drivers or, just as importantly, hidden risks before they invest.
Before the deal closes.
Exactly. This deeper understanding means more accurate valuation models, stronger investment cases internally, and just more confidence in the acquisition strategy overall.
So it's about de-risking the future investment, getting a clearer, forward-looking view. What about after the deal? How does QRR help post-acquisition?
Post-acquisition, those QRR insights mean you can start accelerating organic growth much faster, much more effectively.
How so?
Because you know exactly which levers to pull: sales, marketing, operations. You can implement targeted value creation plans right from day one, less guesswork.
Get returns faster.
Hopefully, yeah. Reduces the risk of missing those initial growth targets. Plus, QR acts like an early warning system for emerging issues that old financials might miss.
And for the exit?
Well, for PE, improving that commercial engine via QR makes for a much stronger growth story when it's time to sell. That can support higher multiples, better returns, a more successful exit.
So QR isn't just avoiding problems, it's actively driving better outcomes across the whole investment lifecycle.
That's the potential, absolutely.
The article mentions specialized methodologies like Angulums. What do they add?
Well, specialized approaches like Angulums offer a structured way to find that untapped potential and fix the weaknesses. They have frameworks for optimizing sales, aligning teams with data, maybe bringing in fractional leadership for targeted expertise.
Right, to turn insights into results.
Exactly, both pre-deal and post-deal during that value creation phase.
Makes sense. Having a systematic, expert approach helps navigate the complexity. Okay, let's switch gears. Benefits for the C-suite, leaders inside tech, media, SaaS companies. Why should they care about QR?
Oh, definitely. For senior leaders dealing with fast markets, margin pressures, QOR gives them a clear roadmap to build a revenue engine that's consistent, predictable, and crucially scalable.
So moving beyond just reacting to shortfalls.
Exactly. Instead of just putting out fires, QOR helps pinpoint the root causes of underperformance. Are sales aligned with product? Is marketing hitting the right audience? Do we lack the right analytics?
It's about getting beyond gut feel to data-backed insights on what's actually impacting revenue.
Precisely.
And once they have that clarity, what's the payoff?
Well, clarity means targeted action. They know where the untapped potential is. So they can refine pricing, improve marketing campaigns, strengthen pipeline management, whatever the QOR analysis points to.
Makes sense.
And as the article notes, maybe they bring in fractional sales leadership or consultants for specific expertise to make those changes stick, stay agile. QR helps make revenue generation less reactive, more disciplined, strategic, and sustainable.
So it empowers C-suite leaders to be much more proactive and strategic about driving growth. Thinking back to that initial story, the failed investment,
Yeah.
it really makes you wonder how different the outcome might have been if QR had been a core part of that due diligence.
Absolutely. In today's world, rapid tech changes, shifting customer preferences, understanding and managing your QOR, those underlying commercial mechanics. It can be the difference between success and stagnation, or worse.
We talked about how financial insight and market analysis are important, sure, but the invisible engine really hammers home that they don't always show you those hidden mechanics driving sustainable growth. The sales process maturity, cross-functional collaboration, pricing alignment, leadership focus. They're all in that engine room, as you called it.
That invisible engine.
And often it goes unnoticed until it's too late. Missed opportunities, bad forecasts, units underperforming.
And the stakes are just getting higher, aren't they? Rising interest rates, intense competition everywhere.
Yeah.
Which is why understanding, assessing, and actively improving your quality of revenue. It's not just another checklist item. It's really a fundamental shift in how we need to think about assessing businesses and driving growth in our own companies.
The invisible engine wraps up with a really provocative question, I think, for everyone listening.
Which is?
Can you really afford to make critical strategic decisions without fully understanding the quality of your underlying revenue engine? It's a strong push to look beyond the surface financials, the market reports, and really dig deeper. Look under the hood of your own company or potential investments.
It's a powerful reminder, isn't it? Sustainable growth isn't just about a cool product or a big market. It really hinges on having that internal capability, that invisible engine, to consistently attract, serve, and keep customers profitably and scalably.
So the key takeaway from our deep dive today seems pretty clear. Understanding and mastering quality of revenue principles is essential, absolutely essential for sustainable success in media and tech, whether you're an investor evaluating deals or an executive driving growth internally.
Absolutely. By focusing on that often overlooked but critical engine room of revenue, we can move beyond just backward-looking financials and high-level market views to get a much clearer, more insightful, and frankly more reliable picture of future success.
Well said. If you want to dive even deeper into QAR and how it applies in media and tech, we definitely recommend visiting Ngulam's website, ngulam.com.
That's ngulam.ok.
Right. It's the source of the Invisible Engine article we discussed, and there are tons of other insights and resources there too.
Worth checking out.
And if you found this deep dive valuable, please do take a second to like and subscribe to Success Beyond Borders. We'll be back with more explorations of key topics for the media and tech worlds. Thanks for joining us.
Thanks, everyone.